That is the closing bell on Wall Street, and now it's market domination overtime. We have team coverage to get you up to speed on the action from today's trade. Want to bring in now Michael Green, Chief Strategist at Simplify Asset Management, and we got Yahoo Finance's Jared Blickreed. Jared, let's start with you on that close.
All right, we were drifting down in the Dow, still managed to close in green territory for the day and also for the week, but we only added about 34 points today. Let's check out the 5-day total, where we can see we were up 1 3/4%. Nasdaq was down 0.4% today, and for the week, still holding on to gains, not quite 1% right there. And the S&P 500 down 0.3% today, just under 1% as well. And we'll check in on the small caps, which were really leading this week. Maybe we can dive into them in a little bit. Up 3.15% for the week, down 2/3% for the day. And just checking in on some of the sector action, I was mentioning an hour ago, healthcare was a leader for not only the day, but also the week and the month, I believe. And we can see it is still the leader today, up 1.7%, followed by real estate and then communication services, staples, and energy. Energy just barely holding on to gains there, and materials just barely in the red. But to the downside, financials lost the most steam, down about 1%, followed by tech and then industrials. As I was saying an hour ago, cyclicals just not their day in the sun today. So here's how things ended in the Nasdaq 100. Mega caps more red than green. We see Tesla and Broadcom there down 1.5% each. Nvidia down 86 basis points. Microsoft, Apple down about 0.5%. Google, meanwhile, up about 0.5%. And we saw a lot of weakness in the chip trade. So if we dive into the chip industry subsector of the tech trade, we see Applied Materials on that weak guidance down 14%. Lam Research down about half that, 7%. KLA down just a little bit more than that. A couple bright spots. We did see Texas Instruments in the green there, and then Intel up about 3%, but looking smaller and smaller there for Intel in terms of market cap. Inside software, we had a much better day than we have for the week. Oracle up 1 1/3%. Cisco, however, kind of bucking the trend there, down 4.5%. Salesforce climbing back about 4%. And I think we'll skip over to the Dow and just see how things ended there. UnitedHealth, it was a week for healthcare, and just let's take a look at the year-to-date on UnitedHealth, and we can see it is up off the lows there. I think it's up something like 19% for the month. Here's the month today, 21%, nevertheless, still down considerably, 40% for the year. On that note, I will send it back to you, Josh.
Jared, while I have you, my friend, one other question I wanted to ask you is about small caps, because they got some attention this week. I'm curious what you made of moves with those pint-sized names.
Yes, well, we can look at two different indices. Here's the S&P 600, and I'll just start with that. And we can see that for the year, they just barely climbed into the green, so just barely break even for the year. But they are now in negative territory, down to 1%. But you take a look after, if you put the reference point for April 8th, and that's the beginning of that post-Liberation Day rally, we can see they're up 27%. And they have led at various times in this rally. But it's been difficult for them to gain any steam, and they've been frustrating a lot of traders. You look over the last 3 years, you can see right here, they are still well off of that peak here. You compare this to the S&P 500, S&P 500 at or near record highs there, different story altogether. So it's been a love-hate story for small caps. I will say this, if you dive into some of the fringier aspects of the trade, I'm not recommending this as a trade, we don't do that here, but meme stocks, we've seen these come alive here. Some of the bigger names down today, like Palantir and Coinbase, but here is a 5-day look, and you can see a lot more green. If I sort by performance, you're going to see a lot of outsized performers here. Fossil, hard to see there in the upper left, but that's up 85%. Open Table, I threw that in there, not an OG meme stock, but it trades memishly, up 62%. Tilray, the cannabis trade firing back here, Newegg up 27%. So some of the fringier names have gotten a lot of love. Is that good for the market overall? Not always, but I think it's interesting to note when that does happen.
Sure is. All right, thank you, Jared. Appreciate it. Michael, I want to bring you in here as well. So another week in the books, Michael. It's Friday, always a good time to take a deep breath. What would you say you learned this week, Michael? What were your big lessons, your big takeaways?
Well, to me, the most interesting part of the week was the fact that we sold off on the CPI, that we rallied on the CPI beat, and then we sold off on the PPI miss very briefly. The irony between those two is that the CPI outperformance was perceived as relatively positive for rate cuts, and then, of course, the PPI miss was very heavily tied into a particular segment of the economy. It was tied to what's called tradable services, and in particular, portfolio management services. As a portfolio manager, I can assure you I did not raise my prices this week or this past month. What actually did happen is that index is basically just a proxy for the S&P 500. So the great irony of this past week was we beat on CPI. That causes the S&P to rise. The S&P rising causes PPI to miss, which causes momentary distress. That was a fun learning this week.
It felt like, Michael, the markets looked at those prints, CPI and PPI, and said, listen, they looked it over and said there's nothing in these reports that derail the Fed from giving us that cut we expect in September. Is that what you saw?
Well, we certainly saw that with the CPI. We saw that pricing back off a little bit with the PPI miss. In particular, as I mentioned, the areas in services, et cetera, those are areas that are going to pass through to CPI and PCE in the next month. That actually lowers the prospect that we're going to get that giant rate cut, the 50 basis point cut that I think a lot of people had tried to price in. We've already heard Fed presidents and governors come out and speak and say, we're a little less favorable. Maybe we're going to be a little bit more cautious after the PPI print.
I've had some economists on the show, Michael, let's get your take on this, who say, listen, stop being so worried about the inflation boogeyman. Inflation's going to come, and then it's going to come, and then it's going to ease. It's going to be transitory. It's not going to be persistent. Stop worrying. What do you make of that argument?
So I generally fall in that camp, and I guess I'm one of the economists that you have on TV that say that sort of thing. But the simple reality is that the underlying forces in the global economy are actually quite deflationary, not inflationary. Slowing population growth, slowing labor force growth. This means all else equal that we need to make less investments to maintain the capital labor ratio, which is used for productivity gains. All else equal, this suggests that there is less pressure than people want. A year ago, all we heard about is the shortage in housing. Now we're hearing about rising inventories and supplies. We have a very, very bifurcated economy right now. And the one thing that I would say that caught my attention and makes me a little bit nervous is in the inflation reports, what we saw is a rapid acceleration in how much the government is paying for things. One of the views on inflation that I happen to subscribe to is ultimately if the government decides to pay more for stuff, the rest of us are going to have to pay more for stuff. And so I'm a little cautious that we could see a pickup in inflation that's a little bit more durable, but we're just going to have to see how that plays out. Overall, I think we have to be very, very cognizant that slow growth is not particularly inflationary.
So let me put a button on this, Michael. Given the backdrop, the environment we find ourselves in, I'm just looking, the popular averages, we were mixed today, but it was a good week, and what a move, of course, off that April low. When clients ask you, Michael, they say, okay, is the momentum going to continue? What do you tell them?
Well, I think one of the key things is what your co-host was already highlighting, which is that in the past week or so, past couple of weeks, we've seen a tremendous rally in small caps, a tremendous rally in what are called heavily shorted names or lower quality names. This is telling you that the hedge fund community has largely been caught off sides. And again, one of the things that caught my attention this last week is the fact that firms like Renaissance Technologies are starting to struggle. Many quant strategies are struggling with behavior in markets that is causing their models to not behave the way that they would expect. The last time we really saw this, unfortunately, was that summer of 2007. It suggests that markets are becoming thin and relatively illiquid, and the prior patterns are not really playing through. That can mean one of two things. Either this is the start of something fantastic in terms of an economic recovery and rally that is led by small caps and cyclicals, or it can tell you that what we're largely seeing, and this is what I think it is a combination of short covering and quant strategies having their grosses taken down. That tends to be what drives the behavior that we're seeing, where large caps and higher quality names begin to struggle, even as meme stocks and smaller caps start to take off.
Michael, always great to see you and great to have you on the show. Enjoy the weekend.
Thank you. You too, Josh.
Well, with new retail data out, we have an expert with us to break down how to play the space, that and more on Market Domination Overtime. July retail sales data coming in on Friday and signaling that consumers are reacting well in the face of a shifting tariff landscape. For more, I want to bring in now Eric Fisch. He's Senior Vice President and Sector Head of Retail and Apparel of Corporate Banking at HSBC. Eric, great to see you, especially on set. Let me start. So you had retail sales today. Economists saying, decent, largely in line. We got that report on consumer sentiment as well. I am curious to get your take, though, on the consumer. Eric, just from your perch, what do you make of where the consumer is at? I had an economist on the show today who said, you know what, in his opinion, hanging in there, resilient.
Yeah, that was the word I was about to use, resilient. If my clients, who are the wholesalers and brands, had been offered this amount of revenue back in the spring when everything started, they would have taken it immediately. I think, we're going to see flat to up to last year, consumers buying, and that's really across most categories.
Let me ask you, talking about your clients, and I want to talk about tariffs, how would you generally, Eric, say they're sort of navigating that dynamic? What levers are they pulling? What mitigation strategies are at their disposal?
Yeah. So the easiest are the ones that manufacture in the U.S. And then the ones that manufacture in USMCA, so Canada, Mexico. Beyond that, the ones in very low tariff potential jurisdictions, so the 10% countries, are doing quite well, and others are trying to shift there. The problem is that many categories are specific to certain countries of manufacture. So as an example, silks, leathers are generally done in either Turkey or China. Footwear is really China, Vietnam. And so if you're in one of those categories, it's very difficult to find another massive country that can handle it. Whereas t-shirts, sweatshirts, sweatpants, the wovens, that's really Latin America business, and you're lucky with 10%.
It's interesting because I would think a lot of retailers thought, okay, listen, I'll diversify out of China, right? I'll make my move to Vietnam, to India. I mean, in the world we find ourselves in now, does that still seem like the smart financial and strategic move, or no, now it's time, if you're a retailer, hey, you better start thinking about other countries, other regions?
Yeah, I think diversification is the right strategy, unquestionably. I think that the challenge is that these manufacturers make decisions that affect them 9 months out, and things are changing pretty dynamically. So the best bet is to diversify and then be able to shift production as hopefully the rates finalize in the coming months.
You got a rush of retailers who are going to be reporting earnings. I'm sure investors who are listening right now, Eric, are wondering, listen, what kind of, because of tariff and the threat, what kind of generally margin pressure do you think we could see? What do you say to that?
Yeah, well, everyone's impacted. And that's, so generally what I've seen is that it's been shared pain. So the retailer, the wholesaler, and then the manufacturer is sharing a third. And so that's gonna hit the consumer as well, some portion of that. I think for this year, many are holding back on price increases to try to maintain revenue. But as we go into 2026, new programs, people are putting new product into production, they're gonna price it in. And so I think it will gradually come across to the consumer. Now, the piece of that we don't really know yet is, as those finalize and people do put in place some mitigation strategies, I think the impact will be less than the headline tariff number.
Let me ask you this, so bottom line for viewers right now who are listening, they're looking for opportunity in retail. Where would you say the opportunity is, Eric? Just at a sector level, subsector level.
Yeah, so two interesting areas. So one, to me, is US beauty companies, beauty and skincare. The reason is because most of that product is packaged and assembled here in the US. So you're only importing the components. That puts them at an advantage against European brands and then the Korean brands that have really come into the market and had a lot of impact. The other area is what I'd call accessible luxury. So the US brands that compete below the true luxury names. The true luxury names have raised prices considerably over the last 5 years. With tariffs, they're not going to diversify production. It's going to be made where it's made. And so anyone who sits right below that aspirational shopper who isn't ultra high net worth, was really splurging on the luxury purchase, is more likely to buy something down a category.
So those are the opportunities. I'll end here, Eric. If those are the opportunities, are there sectors or subsectors I'd want to fade here?
Yeah, I think to me it ties to the manufacturing, and then to the middle gets squeezed. So to me, that mid price point, that department store price point gets squeezed. Off price always does well in a disruption. Generally, more wealthy shoppers continue to shop. So to me, it's the names in the middle.
Eric, great to have you, to see you, and I appreciate your time and those ideas. Thank you. Brinker International, parent company of Chili's, reporting fourth quarter earnings that surpassed expectations. Yahoo Finance's Julie Hyman spoke to Brinker CEO Kevin Hochman about the company's performance and trends affecting that business.
We've seen all the same data that everybody else sees, but we haven't experienced it in our business. One of the things that I'm really proud of the team is we continue to improve our food and our service and our atmosphere, the fundamentals of casual dining. That, with the industry-leading price point of $10.99 for a complete meal, we really think is winning with the customer. I was listening to an earnings call of a fellow CEO in fast food the other day, and he was talking about how his customers are coming up to their drive-through. They're seeing combo meals over $10, and it's making them think differently about that concept. And we've been able to slide in and fill that need. We're doing it with a superior offer, with great experience and a great food, and that's working right now with the guest.
So, as I mentioned, this is a turnaround. You've seen these big double-digit gains. When are you going to start to lap those gains? And should investors then be expecting those like 20% plus gains to go down to the teens or single digits? Sort of what kind of cadence are we looking for?
Yeah, we provided a lot of detail on our earnings call about that, because that is actually on everybody's minds what's going to happen when we have to comp the comp. We had a really great quarter this quarter. We were plus 24. That was rolling a plus 15. So we're already starting into the season of comping some big numbers, and we're doing a really good job of that. And we talked about on the call in Q2, which is next quarter coming up, we're going to be rolling a plus 31. In Q3, the quarter after that, we're going to be doing another plus 31. And we talked about the plus 43 that we're going to have to roll in November. And we expressed confidence we're going to be able to comp the comp every quarter throughout the fiscal year. And that has been baked into our guidance. So there are so many good investments that have been baked into the business over the last 3 years. We're a much stronger concept than we were 3 years ago. And that makes us very confident in our ability to continue to improve food service and atmosphere and be able to comp that comp.
You guys have been spending a lot on marketing. The latest number was $137 million. As you pointed out on the call, you guys have been winning awards for your marketing as well. And obviously, you're not worried about sales, showing any slowness here. But I do wonder about diminishing returns from something like marketing, where when you get sort of fatigue around campaigns and the like.
Yeah, it's just the opposite right now. Because the experience is so much better, we're actually getting a better return on our marketing. So like when I started about 9 months in, that's when we turned on marketing for the first time on the 1099 deal. We saw about a 3 to 5% lift in traffic when we would turn on advertising. A year later, we turned on the same offer and we saw much higher spikes. And I think it's because the experience was so much better that when people come in, they have the exact experience they see on TV, and it gets them to come back more often. So we're bringing a lot of new guests in, and they're frequenting Chili's as often as the existing guests, which tells us we're on the right track there. So I don't think it's going to be a function of anybody getting tired of marketing. It's really about how do we continue to put more dollars into the marketing till, because we continue to get a better and better return on investment.
And you guys are also putting more dollars not into expanding the number of stores, but in revamping the existing stores. I'm curious about the return on investment you're expecting from that upgrade cadence.
Well, the answer is we don't know yet. So we're going to do our first 4 reimages. We call them the modern Greenville image in Dallas here. We're going to learn a lot about that. And then in the back half of the year, starting in January, we hope to start ramping that up with the ultimate goal of getting to 10% reimages a year. We think the opportunity is a lot of our restaurants haven't been touched in 10, 20, 30 years. And so they need a little bit of love. And we have a really awesome design that the marketers have dreamt up of. We've got our design team, our construction team now figuring out how to bring that to life in a cost-affordable way. I think that could be another tailwind to our comp growth that we haven't had before. So continue to be very bullish about all the pillars of our strategy, food, service, and atmosphere. And I think atmosphere over the next few years are going to get a whole lot better with these reimages.
And Kevin, we've been talking all about Chili's. We've not been talking about Maggiano's, which is a much smaller part of the business and also not a performing part of the business. So what resources are you putting into that? And at what point do you say, well, maybe we want to sell it or do something else with it besides what we've been doing?
Yeah, we're excited about the Maggiano's brand. There's no reason why we shouldn't be able to turn it around like we've turned around Chili's. It's a lot of the same challenges that we had 3 years ago on Chili's, we still have on Maggiano's. And so we're going to be focused on food service and atmosphere, food being Italian-American favorites that are served in abundant portions that create incredible value. And then from a service standpoint, it's all about making guests feel really special, almost like they're unchained. Like when we talk to guests, they talk about Maggiano's service when it's at its best. It feels like that local red sauce Italian joint. And so I think if we get back to that North Star and we get really honest about improving in those areas, I don't know why we wouldn't have a great turnaround there too.
I want to ask about some bigger macro trends, not so much about consumer spending, but a trend that we have noticed is people drinking less alcohol. You guys really leaned into cocktails. That's been a successful strategy for you. But I believe the latest Gallup survey showed, 54% of Americans drink now, which is the lowest that it has been ever. Are you seeing any kind of lower ticket as a result of people maybe coming in but not drinking?
Yeah, we've never actually been a huge bar concept. We're a bar and grill, and the grill, we're much more heavily leaned on the grill side. When we were at our best, there's about a lot of young families coming into Chili's. Maybe mom and dad would have a margarita or a beer, and then the kids would have something to eat. And that's really consistent where we are now. Our alcohol mix is only 10%. We actually held it flat, which we think is a win, because we're bringing a lot of innovation to create excitement for the guests to come in.
Time now for what to watch. Starting off on the earnings front, big box retailers are in focus with earnings coming up from Home Depot, Target, Walmart, and more. Walmart announced results for the second quarter on Thursday. Analysts expecting Walmart's revenue to grow slowly in Q2, driven by cautious consumers searching for value amid inflationary pressures. And moving over to housing, we're going to be getting a reading on home builders on Monday with the Home Builder Confidence Index for July. Economists forecasting that number to increase slightly to 34, signaling a slightly improved sentiment among home builders, but still weak overall, with the housing market continuing to struggle. And taking a look at the Federal Reserve, the Fed releasing minutes for July's FOMC meeting, where the central bank held interest rates steady. The minutes giving us more insight into a divided Fed's thinking as it prepares for its next meeting on interest rates in September. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.